Oh, good afternoon, good evening, good morning, wherever you may be. It's 2 o'clock Pacific, 5 Eastern. My name's Steve Hill of AIQ Systems. Welcome to this presentation. We're going to do about 45 minutes, I think, today. And good to see folks in there. Everybody's doing well here. A bit of snow and rain up where I am in the mountains here in the Sierra Nevadas in California. So today, doing a little bit of a different presentation. This is something I've been working on and did for the Technical Securities Analysis Association, and we'll be doing for a couple of other groups on the evolution of AI. And we'll do that. It's not a long presentation. It's just an introduction and a current status. And then we'll have a look at what's going on in the market with relation and specific examples of the AI system within AIQ. So the recording's on. If you have to leave or if you're not in here and you're registered, it's always the case. You get 50 people registered and 10 or 12 turn up. That's fine. We send out the recording to everybody once this is done and it's been rendered in Zoom and popped up into our Vimeo server, and then you can watch it at your heart's content. So let me get started here. So AI, of course, that's where AIQ came from. So we'll start a little bit of the early days, and then we'll move on from there. So let's go. Early systems to modern machine learning. So this is the starting point right here. AI in financial trading. I mean, it has definitely improved over the decades. I mean, both in speed of precision trades, insights, decision making, reduction in human error. All of these things have happened in AI over the last 40 to 45 years. It's been that long. I mean, early AI was very different from today. Rule-based systems is where we came from. Neural networks, we kind of dabbled in that for a little bit, but we've pulled back. Neural networks want to cover what the difference is between that rule-based systems and where we are today, where we have machine learning or deep learning systems that are out there. The early days. So this is where AIQ came from originally, rule-based systems designed to mimic human expert decision making. Now, this is the important thing, is that the inputs into the system were all things that were interpretations or standardized interpretations of indicators, technical indicators or technical rules that were already in place. So these were already tried and tested out there. Taking those, obviously, we use them all the time, right? When we're doing technical analysis, we look for crossovers, divergences. That's what a rule-based system is. The early days of an expert system, instead of us looking at those in isolation, looked at them in combination, which is what we do as humans when we look at multiple indicator confirmation. Expert systems took some of that weight off of our shoulders and gave us, ratings, insights that would take us a lot longer to do, but we could do ourselves. And I've made a note there. I mean, AIQ's 1983, we were known as Criterion Systems. Jerry Smith, Dr. Jerry Smith, who was a Stanford mathematics professor, was an early AI modeler, and he took that knowledge once he'd retired from business and had made some pretty good money at that, wanted to invest in the market. Short story, no platforms out there for individual traders, so I'll build my own. And that's where he and Diane Kincaid, his programming partner, came from. So that was the beginning. 83 Criterion AIQ Systems, 87, still going. That's one. 87 to 92. That's a long time ago now. Barely even do the mathematics, but it's coming up for 37, 38 years. Nirvana Systems, those guys are still out there just like we are. They had a little different way of doing pattern recognition and rule-based decision making. We know the folks over there, and both of us are still going strong. So it gives you an idea of the longevity of these types of systems. So the limitations, and this is something important to remember, it doesn't adapt. And this is pros and cons we'll look at in a moment, but it's dependent on predefined rules. And that, in some ways, means that the goalposts don't. So that has a positive thing, a negative thing. Does it learn from the markets if the markets change? No, but how much do the markets change? How much was already built into technical indicators from the start? So these are all questions that come up in the AI world. So the next set, rise of algorithmic trading. So statistical models and high-speed trading. So firms like Renaissance Technologies, Shaw, started using these types of tools for very high-speed trading. I mean, this is moving averages, arbitrage, mean reversion. These things were all part of, this is some time back, by the way. This is not something that's happened in the last 10 years, 20 years. It's 20 plus years ago. So this has been going on for a while. But this was, primarily this area was for the big boys. They were playing with the high-speed trading. And, this was the days when you needed to be closer to the exchanges to get the data as quickly as possible to shave fractions of milliseconds off of data speeds. I mean, that sort of stuff. Server plants right next door to that. A lot of that has changed. Some of that is still around, but a lot of it has changed since then. So that was, kind of the one of the directions things moved into away from expert systems. And we'll look at a moment in the neural nets and where they went. So you can see, as I said, reduced human intervention, increased trading speed, more complex strategies, and that trades in milliseconds or fractions of milliseconds. I mean, that sort of speed of trading becomes something beyond that humans can do. But we do have a machine doing it for us. So rise of neural networks was the next thing. Introduction of neural networks. Several companies had started doing this in the 90s. Nirvana Systems were involved in that. They worked based upon the neural structures in human brains, recognizing patterns in data. And that's a different method from the expert systems where we had a set of rules and we were just putting the rules together in a decision tree hierarchy type situation, an inference engine, that infers things from one event happening or not happening. Here, we're looking at structures that look at patterns in data and looks for patterns in data that humans may not be able to immediately identify on our own. And we're very good at pattern recognition. However, when the data sets get really large, it gets really hard to identify it. So the neural nets were used in predictive analytics, forecasting volatility, basic financial trends were also part of that, which was a little bit outside of the trading arena, but certainly for use in big economic models. And as I said, the ability to learn and improve from data was the key thing. So what happens here is the data sets keep coming in and get larger. The system itself is able to adapt what it looks for when it sees certain patterns occur. When it happens more often, then it gives more weight to those patterns than to patterns that don't happen so often. And so it can find those complex patterns without us coding it in there. Say we want X number of days of this, X number of days of that. It sees all of the patterns there and it says, oh, well, X number of days, this always happens. Let's use that because it's always happening again and again. So it gives that more weight than it would for us saying, well, just look for this pattern and see how often it happens. This type of learning, I guess it is a basic form of learning, is something that you can do with a standard expert system, but you have to go in there and tinker with it yourself, change the parameters and periods you look at, and experiment until you find something that works. So neural nets do that, but they do move the goalposts around quite a bit. But that's changed over the years. I mean, the early years, they were not unmanageable, but not always easy to understand why it changed. So the generations after that, we're talking about now 15 plus years, deep learning, machine learning. This is a lot different. A lot of algorithms involved in here. They automatically go through the data. It makes subset of machine learning using multiple layers of neural networks. So it's almost like there's different compartments in a brain doing different tasks and then combining them all together. So it's a lot more complex. Gets beyond most mathematicians or even computer scientists to really understand. Only real mathematicians, more than I would understand, are able to do that, to figure out the actual models that you're building and what they are telling you, and why they are telling you it. Key features: self-improving, keep adjusting strategies as data and market shifts. Pattern recognition and prediction is like in the neural nets, but it gets more and more able to detect really complex situations and nonlinear relationships that we might not be able to. And of course, combine that with real-time data, you get ultra-fast decision-making that's going on time and time again. I mean, obviously they're all tested in the sandbox before they go live, but there's still, you can feed in so much data into these systems and let it loose on the world, but then you're in the wild, wild west. You've got extra data coming in that's beyond your original sandbox testing. So firms like Citadel, Two Sigma, and JP Morgan's LOXM system are examples of these deep learning systems out there. I've not looked in depth at any of what these systems do, but again, this is all, a lot of the big boys are involved in this arena. So this, I had a chat GPT for build me a table here, just to, the differences between those systems there, what they do and their strengths. You can see expert systems where AIQ came in, rule-based, easy to interpret, rule transparency. You know what's going on, mostly. But it doesn't adapt, no self-learning. Algorithmic statistical models, fast execution, less errors, but it also needs predefined strategy. Someone had to write the algorithm, right? Then we get into neural nets, pattern recognition, keeps recognizing complex patterns that we wouldn't be able to easily recognize. It's interesting, the weakness, high computational cost and complex setup. And I think that's one of the reasons in the 90s when we moved away, we looked into that arena, but so the problem was there was not enough, I would call it hardware capacity within local machines in order to be able to make this work very well for us. So we didn't go any further on that pathway. So neural nets were never incorporated into AIQ. And today, of course, machine learning, data-driven, massively fast, all sorts of things going on, including interpreting news, rumors, social media. I mean, we're going to look at that in a moment. It's just incredibly complex now. And there's some pros and cons to that. So how does it improve trading performance? Well, this is just a repetition, predictive analysis, market trends, stock price movements. We have some of that in the expert system. Risk management, we don't do that with the AI model that we have, but it's definitely part of the models that are out there. Certainly for brokers dealing with balancing large portfolios for their clients, that's a big area now. And of course, trade execution efficiency, especially when you've got a big trade you want to put out there. There's a lot of different things that the AI can help in making that trade happen efficiently at the right price and save money, and also without reflecting in the price of the stock too much. Yeah, so for high frequency trading like Citadel is leveraging machine learning for microsecond trades. We all know this stuff. It's all out there going on. We can't compete with that, obviously. There's no point in us even trying to. In fact, you can't even get on the coattails anymore of this because it happens so quickly. Yeah, robo advisors using machine learning to rebalance portfolios. This is a good thing. I mean, it's a good thing, based upon investor profile, risk aversion, age, amount of money, capital you want in different areas, all those things. Those sorts of AI systems are very useful. I think Robinhood and a couple of the other retail brokers now are beginning to roll some of that out. Robinhood bought Pluto back in June or July, I think, and they've got some, not only that, they have other statistical AI models in there, which I think they're going to bring into their trading arena. So that'll be interesting. Challenges and limitations, yeah, fails to account for black swans or some of those chaos events and unforeseen market shifts. And we'll run a sort of example in a little bit about how that happens and what events occur. And, really, again, who's in control here, right? I mean, who's in control? So this is where we get into who is in control, role of human traders and oversight. So the big, when if you were a trader, you're a market maker. I mean, whatever you were in the old days, I mean, you had some pretty, you wielded pretty big power out there. If you're involved in open outcry in the marketplace, all of these things were part of what we did. Now, of course, almost 99.9% of this handled by computers. So what happens to the humans trader role? Where do they exist in here? Well, they're the next level up. There are different type of person now. So your decision making is ensuring that the trades that the system, the AI does, actually aligns with your strategic goals, whether it's you're a sector mutual fund manager, whether you're a hedge fund manager. You need to make sure your goal is now to make sure that the technology matches the goals of your organization. So that's, again, this is all back at the higher level from us as individual traders. And then you've got to monitor the AI models because we know what can happen and intervene, like press a button and stop it, which is, it's got to be the worst thing to happen to any of these AI models out there trading. And then you've got to look at the results going forward on a pretty timely basis and adapt and broaden them to whatever's going on. I mean, if your AI model's not working, you don't want to keep it going, right? I mean, that's a key thing. So it's all oversight. And this is, again, it's biases. I mean, biases are built in now in algorithms because algorithms are learning from other algorithms, and you get this sort of internal looping going on. And then, of course, there's the risk management. So the cascade effect. One algorithm gets triggered, a bunch of sell signals go off. Does that trigger, even in the same organization, another algorithm that's trading something else to go out and also trigger a bunch of sells? So there's a lot of oversight in there. And also, you got to make sure that it remains relevant. So there's still lots of work going on here. It sounds not that dissimilar to what we're doing as individuals, but it means that there's a much faster system doing all the trading that you would be overseeing if you were a money manager like this. So a quick look here. Here's some of those modern tools. I mentioned a few of them. Robinhood, I mentioned that earlier. AI-driven insights, AI to predict risk and improve portfolio management, and of course the high-speed stuff that is not something we can compete with, but it is out there and going on every single day. Here's the advantages: real-time adaptability, as I mentioned. The expert systems and neural nets didn't do a lot of learning. Modern AI reacts in milliseconds, and advanced data integration. It also brings in the social sentiment. I mentioned that earlier too. Use an economic indicator. So you can throw in a bunch of parameters into a statistical, a deep learning system, a deep AI, and use that as part of the analysis for making decisions on trades. And that's and again, that's, social sentiment. Who drives social sentiment? I mean, the number of robust news stories out there. Most news stories nowadays are conglomerators. They grab news stories from various sources, rejig them, repackage them, and send them out in milliseconds. So how does the AI discern, oh, well, there's 5,600 news stories or rumors on this stock, but how much of those are originals and how much are regurgitated? Does the AI know the difference? How much weight do you give these things? This is becoming a very, very complex area that's going to need lots more oversight. So risks and future directions, I'm sort of getting ahead of myself here. So flash crashes, the 2010 flash crash was a classic example, even though that was actually human instigated. It actually led to the AI and algorithms also firing up a bunch of cell signals and sending a cascade in effect to 1,000 points in almost no time at all. And then it came right back. That sort of move like that, especially if we have stops intraday, just took us all out. And by the end of the day, we're back to a sort of where we were at the beginning of the day. That's a problem. That's a problem. Again, potential for algorithmic biases to impact markets. Well, of course, because these are these same things. If the algorithm has an error in it or is something that gives too much weight to one area, and it goes back to that social stories, news stories, can that have a cascade effect and knock off other sell or buy programs, whichever way it goes. And of course, poor data. I mean, it's only as good as what the data is. We all know that. You've got bad data going in, the machine doesn't care. Even if it's an AI, you could even have an AI that might, be able to throw out some of the bad data. Well, but maybe that's not bad data. Maybe it really is a 1,500 point move in the Dow in one day, right? I mean, this is, how do you know? So future direction, transparency, I think, is going to be key. You got to be able to see what's going on. And I think the regulators, especially, ESG, when you're talking about environmental, social, and governance factors and ethical trading goals, the machine doesn't really know. The AI doesn't know unless you tell it that. I mean, there's obviously these are all factors. And this big one here, enhanced AI tools for detecting market anomalies. So we're now going to have AIs watching the AIs to make sure that they're not doing something bad. It gets a little scary out there. So modern AI trading systems, we looked at that a moment ago. So let's just quickly, as I said, didn't want to spend a long time in here, just to give you an overview of where AI is at the moment. And I've been doing a lot of research on it, not because I think that we can actually take advantage of it at the moment until it's sort of filtered down enough within brokerage or within trading systems. The modern machine learning is just so fast and so vast. It takes a lot of power for it to make it work. So this is what happened. The stock market plummeted nearly 10% within minutes of raising millions in value. So this is kind of what happened in that 2010 event. I think it was a Singapore trader who front ran the market. I mean, literally threw a bunch of trades out there and profited amazingly out of it before he was caught, of course. But the investor panic and the circuit breaker activation isn't quick enough to stop some of the algorithms already sent the trades out there. So, how quickly do you stop that? Oops, I'm going to go back there. Getting ahead of myself here. So investor panic and immediate circuit breaker activation. So that's what happens in those. And again, black swan events, flash crashes, whatever you want to call it. The role of AI, it just keeps making those trades faster and faster and faster based on data and market conditions. Something triggers a sell-off, whether it's a rumor, whatever it is. It could be the algorithm in itself is analyzing news. It could be that the news already causes some reaction in the marketplace that then triggers a whole bunch of cascading effects. And then that just continues. Another algorithm goes, another one goes, and another one goes. So it just escalates. And how quickly can we stop that from happening? It's like pulling the circuit breaker. I mean, this is happening at millisecond speeds. I mean, it really is. So, and the impact, of course, is losses. The retail investor obviously gets hit if they've got stops going during the day. If you're only doing stops in the morning and you're sort of, I have stops on all the time, so I get stopped out. The whole reason of that is to protect me from a loss. In this case, it protected me from a loss but it only happened in a very short period of time. And these events make me think about how to make this happen in the future. Circuit breakers, yeah, but it's only it curbed it from cascading to an even worse situation. Is it fast enough? I don't know. So it highlights the risks and what that's going to mean going forward. I mean, can the circuit breakers react fast enough? Well, they do a fairly good job now, but still, we still get these massive moves. So the SEC, CFTC, I mean, they look at the AI driven sell-offs. You want circuit breakers for more gradual pauses. This is a good idea, so you can kind of slow it down a little bit. But I mean, you've got to test this, and then the algorithms are always working faster and faster. They want to get an edge over the other algorithms that are out there. You want to get an edge. These guys want to get an edge all the time, and that is making trading, especially for day traders, it's really difficult out there. And so someone's got to monitor that abnormal trading. Someone's got to make sure that it's working okay. And it's probably internal. So, I mean, the guys now, instead of being a top trader, you're a top programmer, algorithmic expert, someone who's able to make sense of what's going on with these systems and be able to advise both their senior partners, board members, what's going on. Because otherwise, how would you know what's happening? You don't. Yeah, so just saying here, we get efficiency, we get a lot of things out of AI, but there's definitely going to have to be a lot more regulation out there. It's going to happen because there'll be another one of these AI-driven events, and the breakers won't be fast enough. They'll put a brake on it, and then all of those AIs that have been about to hit their stops or buying programs will be halted temporarily. Everybody looks at what their system's doing. The breakers come back on, the market goes back and returns to normal. That's not an easy environment for us to trade in. Last bit here for you. This is 1962, right? This is Life magazine cover. I love this cover. The wild stock market. what went wrong, right? I mean, so there's nothing new. The market's always going to have something happening. And in this case, we had a very strong bull market in the 50s, and things got out of control. And this was probably just a regular correction. I forget, it was like 12%. I mean, this thing happened. Some of it came back. It was not it was a jolt. Certainly was a jolt. But now, this was just human driven, no AIs or computers or very basic computers back in 62. Now this is happening faster and faster and faster. Do we have the ability to put a control on it? So, for again, having looked at the neural nets as a method of looking for patterns, was very intensive on processor time back in the 90s when we looked at it. With the expert system, you do know what you're getting. You get an expert system that is programmed based upon a bunch of indicators, 400 plus rules, that are set to how those indicators were created by the mathematicians, analysts, technicians in companies that created those. John Bollinger, I mean, Gerald Appel, Wells Wilder. All of these people were highly skilled in analysis, and they created indicators with recommended settings that they had tested over a substantial number of markets over many years. So at least for the expert system, you know what you're getting, good and the bad. Yeah, it doesn't change, it doesn't adapt. But what it does mean is that as you're going forward, the goalposts aren't moving, good or bad. And that's kind of the position where we are with the AIQ expert system. So that's kind of just wanted to give you that history there. That presentation's available. There's a URL there if you want to share that or use it anywhere. It was just something I prepared for a couple of presentations I'm doing for other groups, and it's kind of it just gives you an idea of where AI is in relation to financial market and trading. So now, for the last sort of 15 minutes, just going to have an update on where we are in the market right now. A real interesting year, really. A couple of things. I'll just go back. This is back to the beginning of June here. Signals we've had on the market. I'll just take these off of so we can see this a bit bigger. I've annotated the arrows for high expert ratings down or up 95 or greater. For those of us who've been here for a while, we know that's what we're looking for. Of course, every one of these, I can have a look at the rules that fired and see what's going on. You can do this yourself, of course. And all of these rules, again, this is an expert system. So this is widely accepted in technical analysis rules for 40, 50 years, 60 years worth. Some of these are in here. We know what they say, we know what they do, they don't change. They're not adapting, they're not moving around a lot. So in a case like this, I always explain for folks who don't use the market timing area in here, the biggest part of this AI system, of the two systems we have, one is for stocks and one is for the markets. DJIA is the symbol. We take the price data of the Dow Jones 30 index, and we run analysis on that price data in relationship to the breadth data of the New York Stock Exchange. And there are 400 rules in relation to both the price on the index itself, both the breadth data and a combination of the two together, looking for divergences and other situations. So for example, back here, I'm just looking, we had this down signal, and this was back on June the 7th. They had a trend status had changed to a weak uptrend, right? But this is a sell signal, so that's why it's not 100. But the advanced decline had turned negative when the up-down volume oscillator and the advanced decline oscillator are already negative. So you can see, there are circumstances here. This is a combination. It's a decision tree. When this event and this event and this event happen, go check these indicators. And then it just keeps adding to the weight on the bullish and bearish side until it runs its way through the whole decision tree process. When it gets to the end, at the end of it, here's the rules that were bullish and these were the bearish and what weighting they had. And that's how you get an expert rating. And that's how it worked. That's how the early AI systems work and how this one still does. So, the information you get is, the advanced decline oscillator, things like 80 oscillator, 80 line, when you have a market that's like this one here, you get a sell signal here because this has turned negative when this has been going up. It's basic divergence stuff, but the system takes away some of the visual or interpretive that we have to do. So, in a case like this, we've seen this all before. You get this happening, and here you've got this kind of going down to here. And over here on the AD line, it's already going down, not strongly down, but that's enough for the system to fire at that point there. It's enough for it to fire and say, hey, you know what? We've got a divergence. Let's go check this indicator, see if it's diverging. Oh, it is. So that adds more weight to this number, the down number. And once we get 95 or greater, of course, then that's a significant signal. We've used in the past, and we still do use price phase. You can use that as a confirmation. One of the reasons why it's kind of good to do that is that these indications can be a little early. This one wasn't too bad. The market didn't move down a huge amount from here, but it did move down. This one here, this was early July. We had a whipsaw here. We had a down signal and then an up signal. Price action was pretty narrow during this period here, so it's a little inconclusive. Not great, but it's not perfect, right? There was another up signal over here, but it was a little early, and again, it was all to do with there's some divergences happening in the price volume action. So when I look at this ER here, and let's get to it. It's on the wrong day. There we go. Oh, no, maybe there wasn't one there. That must be my sticky. Oh, no, there isn't one there. This has moved. I've changed the font on here, so do excuse that. I'll get rid of this. Yeah, go. Because there wasn't one. That's right. We had this up signal here, and it just kept going. Even through here, there was no down signal. You don't always get a signal. This down signal here was a few days early. It's interesting to note. I found this recently using the Heikin-Ashi charts. Is that if you get a down or an up signal, if it's a down signal, and wait for the bars to turn red. So here, there's a down signal, wait for the bar to turn red. Up signal, wait for it to turn green. Oh, it's already green. This is kind of good, actually, because you see it here as well. Because we know our system is fairly early, here's a down signal, but we wait for it to turn red before you do anything. Here's a down signal here, you wait for it to turn red. Here's an up signal here. Now, this is what we're going to look at in a second. We wait for it to turn green, which was right there, of course. So this was, we've had a few signals. It's a quiet period during here. It's very unusual to be so quiet in there, just because the market was not moving around in any huge way to fire any signals. Even this area here didn't fire a signal. So over here, this is really interesting. Obviously this is the markets here. There's obviously between this up signal 98 on October the 31st and this one on the 1st of November. Both of these are strong up signals, one day after another. And it's a sure sign that there are internals saying, hey, you know what? This downtrend's over. There's going to be some movement to the upside. And again, this is all to do with, look at the rules in here. In this case, we haven't seen this one for a while, actually. Money flow reversed and is now advancing in this descending market as a weak bullish. Rate of change of the ESA price suggests a strongly downtrending market is forming a cycle bottom. So this was kind of what was happening on that second signal there. It's seeing that the money flow is coming back into the market itself, but at the same time, we're also seeing a sort of cyclical bottom based upon exponential moving averages. The day before, so we had intraday low prices decline to a 21-day low. Then it had the volume accumulation percentages positive. We don't see this one very often either. So this is kind of a sign that there is some definite movement happening within the market itself. Closing prices declined to 21-day low, but breadth as measured by the AD oscillator is increasing. So again, you're seeing this happening within a situation where the market itself is still on its way down. So both of those signals came. Next day, nothing happened. Next day, we turned green on the Heikin-Ashi. I like that. Oh, the other thing I also like in here, put these on, especially at the lower band, is the Bollinger Bands. Always love Bollinger Bands, especially at the lower band. Upper band, it sort of runs up the band quite often. You can see that up here, this is very common. Up the upper band, up the upper band. Let me just switch it to regular candlesticks a moment. You, you can see here it runs along the upper band quite a lot. But with the lower band, it sort of gets close to it or hits it or just cuts through it, seems to move that away from it. Same here, cuts through a couple of days, moves away, cuts through one day, moves away. And then we got here, we got very, very close to the Bollinger Band, lower band again here, and then it moves away. So I kind of like seeing that. On the upside, it gives me less information, but that with the Heikinashi and the expert system is kind of now a thing I look at. So when I go back, watch when I switch into the Heikinashi view, we know the calculation in here is looking for trending periods for us. That's why we included this. We really like this indicator. Here it's turned red again now, so that's a sign we might be switching around from here. So again, this is data through last night's close, of course. So this is, the first time we've had two signals in a row together for quite a while. So that was a pretty good signal right there. And then after the big 1,500 point day, we had another up signal anyway. You might think, well, I've missed the move, but you know what? It's kept on going upwards mostly since then. So the rating system itself is still doing a fairly decent job for us on what's going on in the marketplace itself. I haven't downloaded, obviously tonight we haven't got data through what's happening today, but we'll check that out. The reports I ran, let's have a quick look at what's going on within there. So summary reports, market log, nope, don't have one in there. So why don't I quickly generate one from last night? And we'll do a generate all. Actually, let's do this. Generate all from the 13th and just see what's going on in the logs so that we can get a little more of an expanded view. Just running through off screen there. Boy, this used to take forever. Back in the old days. So let's see what's going on. So here we are. This is 11:13 on Wednesday. So you can see the most recent high expert rating was only 9 days ago, but that's the third of that cluster, really. So that's still in place. We always know that. How the market changed, pretty unexciting day. Two fear areas here, if you're not familiar with what this does. Weighted action list is WAL, unconfirmed signals. Both of these are expert system-based percentages. This one and this one are both done on whatever stocks are in your database that you're looking at in the reports. Could be all your tickers, you could be doing on a subsection. The big thing here we look for is a high imbalance. 20, usually 10 to 90, 90 to 10 is the really significant changes. What this means is, I'll look at this one first. Unconfirmed signals is the real early view. It looks at every stock in your database and says, hey, do you have a high expert rating or not to the upside or downside? If you have, let's count the number that have high up versus high down, and you get a percentage. It's a real raw expert system look at every stock. So in this case, 32% of stocks in my database that had a high expert rating had a high expert rating to the upside versus 68 to the downside. So it's a raw number. It's usually the earliest signal of things that could be changing around. The weighted action list is a confirmed one, confirmed by price phase indicator, confirming the expert rating. So this one's kind of already happened or has been happening. So in this case, 28% of those with high signals with confirmation were to the upside and 74% to the downside. So we know that this is a counter trend system, this expert system, and these are usually early indications that things may be changing around. So remember, this is today's data for these. It's looking at today's data. Yesterday's data. Whereas the expert system on the market, the last high signal was 9 days ago, and it stays in place until something changes. So good information there. The groups are still fairly strong. 64% are trending up, 36% trending down. But there has been a sort of shift to the downside. The groups are beginning to move down a little bit. Mostly bullish across the board. First level of indicators are on the price action and volume. The second indicators are on the breadth data of the New York Stock Exchange. Bullish mostly. Remember, this is yesterday. bearish on VA percentage and AD oscillator. So remember, both of those were VA percentage and AD oscillator were involved in the move up signals over here. So these have turned to a bearish mode. That's an interesting point. So we may be seeing some sort of rollover going on there. So that's where we are in the market at the moment. Today's data, once I get that in there, we'll have another look. Not today, of course, but another time. That's pretty much all I wanted to cover today with our market update. And hopefully you enjoyed the AI presentation. It's hard, sometimes to know when you hear AI in the marketplace, what does it really mean? Really, most of it doesn't affect the softwares, the trading platforms that we use a huge amount because most of the developments are in the high-speed trading arena still. But it can also, it's creeping into the portfolio balancing for individuals as well. And I have a Robinhood account, a Merrill Edge account, Thinkorswim as obviously with Schwab. So all of these brokers are all, they're dabbling in there right now. They're sort of integrating AI into their tool set. But I think it will move into analyzing your portfolio on a greater extent to recommendations on monies in high risk, low risk, how much do you move to bonds, and all those sorts of things, how much do you move to cash. That type of situation is probably going to get bigger and bigger within those accounts as we go forward. So that's it. If any questions, pop them in the chat box here. I will have this recording probably up there tomorrow by the time it gets rendered, popped up into our Vimeo server. And it'll be there forever and ever. Well, a long time anyway. We're going to do another session, actually, probably going to be early December, we're looking at, because I've got a couple of events coming up for our UK area. We have a big market over there that we deal with too, and there are different types of traders over there. A lot more novice traders. So I'm looking really to do something more advanced for us over here, and I think we'll get back into more of the trading strategies, and especially some of the done some back testing, always back testing things, and there's some good stuff out there that I can share with you. And again, we also analyze the stocks and commodities magazine trader tips that we have the code for that published in that magazine, and we'll look at some of those as well just to see how they're faring. They're quite complex, some of the strategies, but they're well worth looking at. So that's it. Questions? If there's no questions, I look forward to seeing you next time. Thanks for spending some time with me. I always enjoy sharing what we're doing here, and we'll keep doing this as we go forward. Great. Have a great evening. I'll talk to you soon. Bye-bye.